Okay, I'm back now. Are you able to are you still there?
Yes, we are
Yes.
here, sir.
Good. So this GDP or GNP, the idea is to know the health of the economy or performance of the economy, basically. And as I have said, you can compare one country to another, but there are problems because when you compare one country against another, so Tanzania versus Malawi, there are so many things that are different that the GDP itself doesn't give you a good answer. As to, for example, it doesn't tell you the well-being of individual citizens. So let's say Zambia having bigger GDP does not mean that people in Zambia are living a better life than in Malawi. Sometimes it is true, but sometimes you need to do more analysis for you to meaningfully assess the health of the people, individuals in a particular country versus individuals in another country. Just using these aggregate figures may not actually explain whether there is progress in terms of one country to another. So, for example, GDP, as we said, refers to market value. It doesn't tell you whether it is just a result of price increases. Okay, it may just be because of inflation. So you need to look at inflation for each country to see whether these increases are real or market. Market prices can be rising. So those are some of the problems, shortfalls that you might find if you blindly try to compare these figures. The same thing whether you are comparing between one business to the other. You might have the same kind of problems. Why one company is showing that it's making more profit than another doesn't mean that that company is well run. It does mean that the managers there are more capable than the managers who are not making as much profit. So if you are looking at the economy of Malawi growing less slower than another economy, it doesn't mean that the leadership in Malawi is weaker than the other or whatever. It doesn't. We have to be more careful at how we compare between businesses or between countries. Now, one important thing about GDP is that it gives you, apart from giving you the performance of a country, it will also give you just wondering, I'm trying to see whether I'm recording. I hope so. Is anybody able to see whether we are recording? I'm recording or not, or maybe it's only me who can know that.
You are recording, sir.
Okay, that's good. Now, the good thing about when you look at the various items that are forming this GDP, remember I said even Batan or Singano or whatever. We count all those things. So you have sectors. So it can be the energy sector. We measure, we value what, for example, what Ijenko has produced. You know, in money terms, we value what Longwater Board has produced. We value what Shayona has produced. We value every activity. So from there, you can also be able to identify which sectors are growing faster, which sectors are contributing more. And on this juncture, I would like to ask you that in your spare time, try to go on NSO website, National Statistical Office website. In there, search for GDP for Malawi by source. It will show you how each sector is contributing to GDP. Now, it can also show you over the years which sectors are growing faster than others, which sectors are weaker, which sectors are stronger. So therefore, you can devise policies to attack, sectors that need, a bit of pushing, or you can devise policies that can promote or encourage those sectors which have got the potential to grow even faster. So they give you a picture that shows how well you are doing and what you can do more in those particular sectors. So that's the good thing about it. Okay, this slide I have explained. Now, avoiding multiple counting, we have already mentioned it, that we should always try to avoid not to count things twice because we will have false figures. Now, some of the things that to avoid, I think they come under 2 or 3 categories. One is the issue of intermediate goods, meaning goods that are used to produce other goods. So the value of intermediate goods should not be counted twice because they would distort the value of GDP. So avoid that. If you are in NSO or whether you are in the Reserve Bank or you are in National Economic, I don't know where you guys are working. If you are in that section that is responsible for coming up with GDP figures, those are some of the things that they try to make sure they avoid. Nikiwe Ruhanga. Are you listening to the lecture or you are drinking your drink all the time?
I'm listening and drinking.
Okay, I hope it's not distracting your attention.
No, I'm thirsty.
Okay, fine.
Thank you.
So an alternative way of avoiding multiple counting, as I said, is just to go through value-added approach. If you know you cannot avoid, if it is difficult to avoid identifying final products, finished products, then you are better off using the value-added approach. But if you are sure enough that this product has reached a final end, when we say final products, what we mean is products that are now available for consumption. Consumption by whoever, by companies or by individuals or by government, because all of us consume things. So for example, soap, maybe soap, the final thing is that you use it. You are not using soap to make another product. Because if you are using soap to make another product, then you have a problem. Because it's better then that you measure that other product that the soap is used to make. So those are some of the things that you have to be sure about. So value, there is just an example of value added. For example, if you are talking of a woolen jacket or whatever made out of wool, you would be making that wool is from sheep. So it's just an example of what we mean by value added. Now, other things that you need to avoid are what we call non-production transactions, or transactions that are not meant to produce anything. If a transaction is not adding any production to anything, avoid those two. So a transaction has to add value to something. So non-production transactions should be excluded. And these non-production transactions come in two forms. One is financial transactions. Second one is second-hand sales. Those cannot be included in GDP. So financial transactions, such as, for example, public transfer payments. Mtukurapa Komo, for example. People who are getting Mtukurapa Komo are not producing anything. You guys who are waking up every morning to go to work and back, when you get paid at the end of the month, you are paid for production. You are being rewarded as a factor of production, labor. You are rewarded a salary or a wage. Mtukurapa Komo is contributing nothing to the economy. So those incomes are not paying for some production. Okay? So don't. Also, other transactions, apart from public, you can also have private transfer payments. So if you have children, you give them some pocket money. You give them some change. Quite well on the income, but they have not worked for it. Even by the end of the year, they may say they make it 10,000 kwacha from mommy. They have not made it anyway. It was just a transfer payment. They didn't do anything. Unless if, I don't know, I've never seen parents who give money to their students based on chitimena apanga. I don't know. But in general, what parents give to children are just transfers. They are not producing anything. And then you have financial transactions. So one is transfers, the other one is financial transactions. Financial transactions are also some kind of, they're a form of transfer. So for example, if you go and buy shares, you spend money on buying shares or stock or bonds, you are not contributing to any production, because it's just a transfer. I am selling shares, you buy them. So they are just being transferred from me to you. There's no production involved. But if you engaged a broker to buy the shares for you, so you didn't want to go to stock market on your own, but you used a broker. Broker services, yes, because they are contributing to GDP, because it's a service that they are providing. So it's okay. But the buying and selling of shares on its own should be excluded. And then comes the other one, which is second-hand sales. That too should not include. So, for example, you have bought a cell phone and you haven't used it, and then tomorrow you sell it to somebody else. As long as it is you who bought it, the moment you sell it to somebody else tomorrow, it's a second-hand sale. So it cannot be included. We have already counted that. It will not increase, it will not include anything. So whether you have a car and you bought a car and then you sell it, is second-hand. You cannot count that. Even if you sell it brand new, if you have bought a car from Toyota Malawi, drove it to your house, and the next day you sell it, you haven't driven it around, it's still second-hand sale. Now, any questions so far? Okay, so now let's go to how to actually measure. How do we measure GDP? We have been talking about it, but how do we actually do it? There are three approaches. It depends on what book you read. Some books, they will put two approaches, combine them into one. So they will say there are two approaches. Other books, they will tell you three approaches. So the items are the same. The categorization is what might differ. It's just preference. So one is what we call the production approach. Production approach is basically looking at the value of what you have produced. So you take bread as what you have produced. How much does it cost? 2,000 kwacha per loaf. How many loaves of bread Malawi has produced in a year? 500 million loaves of bread times 2,000 kwacha. You will find the value of bread. Or you can use value added approach. So now, if we do that, we have separated production and value added. So we have the value of the final product, or we have taken the approach of adding the value added at each stage. So some people separate these into two. Now, the production approach is also sometimes referred to as expenditure approach. Our expenditure approach is because we will be counting the loaf of bread. How much have every bread that has been produced? We're assuming we have bought it. We have spent money buying it. So if we add up what you have spent on bread in a year, what I have spent on bread on a year, what Stella, Gracie, When all of us, Diana, we all add up how much we have spent on bread, and then we'll find the total. So that's the expenditure approach. We'll add what we have spent on cement, what we have spent on electricity, what we have spent on water. So you can use what we call expenditure approach. So some people have put this output approach and expenditure approach as one. So they will say two, there are only two ways. This one, and then the next one is what we call income approach. So as you can see on this slide here, we are saying two ways of determining GDP, of calculating GDP: spending and income approach. Spending can be into two forms: value addition or actual final value. Okay, so don't be surprised if you read another book which says 3 approaches. It's because this spending has been divided into 2: the actual spending and the value added approach. So the last one is the income approach. The income approach refers to factors of production. So the factors of production: land, labor, capital, and enterprise. What economists believe is that if you take bread, you should be able to see how much labor in that value of bread. There is labor, there is capital, maybe land in there, and then there is profit. So economists believe that whatever production you have, that production has used these 4 factors. So it's either the cost of production plus profit. So all the production costs plus profit will give you the value of bread. Now, profit is that 4th factor of production. So basically what we are saying is that labor, capital, and land is what would constitute the cost of production. And then plus profit, that gives you the value of the bread. So if you use this approach called income approach, you should be able to arrive at the same answer as somebody who's using the expenditure approach or somebody who's using the value addition approach. The answers should always be the same. So sometimes in an exam room, you have the data there, and then you may be asked to show that you should use these approaches and see if you get the same answer. Prove if you can get the same answer. Okay, so the theory is that the answer should always be the same. Whatever approach you use, the answer should be the same. Because the production process gives you incomes for the factors. So after you take care of all the production costs, still you have a component where a profit is added so that you can find a sales price. I hope that makes sense. Before we go any further, any question? No questions. Koma lero ndiye muli anthu mwazuka ndi nzeru kwambiri, simukufunsa atu. Zonse zikungomveka bwinobwino. So, whether you are using the expenditure or output approach, that should be equal to your income approach. You can see that what you have on your left should equal to what you have on your right. And on your left, they have put the expenditure and value added approach together. Now, the expenditure approach, let's explore more about the expenditure approach. So basically, we're looking at these goods that are produced, the final products, and what the market value is for those final products. Now, whatever is produced, the assumption is that whatever is produced, people buy it, or it is bought and consumed, because we're talking about final. So it's either by you and me, who are the buyers, or it can be companies who are the buyers, or businesses, or it can be government. So if you take maize, for example, it's either you and me who have been buying this maize, or maybe the government is buying to feed the people at the hospital or whatever. Or it can be businesses which are buying it. Okay? And then we should remember that not all what we produce is completely bought. Some of it, for example, will be in a warehouse, inventory. Some of it is bought by foreigners. You send it, you export it. So all that is produced is not the expenditure side of it, does not capture everything. If you just look at households, businesses, and government, and some of which is exported, some of which is is an inventory. So we must make sure we capture the whole scenario, the whole system. And also remember that whenever you go and buy, let's say, maybe example, let's say cement. You know, we may have exported some cement, but sometimes you go there and buy cement which is not made in Malawi. So we should remove that. We should remove the cement that has been bought but was not manufactured in Malawi, because we are looking at what has been produced within Malawi. That's what GDP is about. Now, an expenditure approach is sometimes given as GDP is equal to C plus I plus G plus X minus M. C is private consumption. Consumption by you and me and government and private sector. I is investment, which is also including inventories. What is in stock or what is being used to produce something else. So for example, some of the maize may be bought by a company for them to make chicken feed. So that is bought for investment. Then government also spends money on maize. Then some of which is exported. But we may have also gone to buy maize, which was actually not produced in Malawi. So exports minus imports, so that we only have the net. So that's one of the formulas that is used for expenditure approach. Expenditure approach has got this formula. That is very common. Now, while we are on this formula, I wanted to bring to your attention this issue of X minus M. X represents exports, M is imports. So when you say X minus M, exports minus imports, this thing is called trade balance. The definition of X minus M is trade balance, because we are talking about trade between one country and the other. So we are exporting something to Zambia. We have exported some maize, but some people also imported maize from Zambia. So what is the trade balance? So exports minus imports is sometimes referred to as trade balance. And this is where we come in with the study of exchange rates, balance of payments, foreign exchange reserves, forex issues. They come in when we are dealing with this issue of exports minus imports. Because there has to be some way of Malawians finding the dollar or Zambians finding the dollar. Because if a Zambian comes here to buy our maize, the maize in Zambia, in Malawi is demands that they pay Malawi kwacha. And if we go to Zambia to buy something, we have to pay Zambian kwacha. So we have to go and we need to change Malawi kwacha into Zambia kwacha if we want to go and buy from Zambia. Zambians also have to change from Zambian kwacha to Malawi kwacha if they want to buy products here. So the supply and demand for foreign money or foreign currency is based on this issue of demand and supply of foreign exchange. When we say demand and supply, basically, so let me give you an example. An American comes in to buy beans at Deza. A German, a Japanese, whatever, they have all come to go and buy beans at Deza. Beans at Deza are sold in Malawi kwacha. These people have arrived in the country, but they have got dollars. So they have to go to the bank and change their dollars into kwacha, so they can take the kwacha and buy beans udezako. Then they'll come back with the beans and fly away. So they have left the dollars here. Now, can you imagine if there were 1 million of them coming in one day to go and buy beans? Everybody wanyamura madora ake. There may be a time when the banks in Malawi are starting to run out of kwachas. Makwacha amba kusowa, anthu achuruka ofuna nyemba. Anthu achuruka ofuna nyemba, abwera ndi madora awo, so they have to find kwacha kuti akagule nyembazo kudezako. Now makwacha awo ayamba kusowa. So some of them will start going black market kukafunafuna makwacha. Kubanki atha, awupita ku black market akayamba kuwadulisira. Kuti makwacha anga ndasala nawo ochepa. Ngati mkuwafu ayamba kulimba nawoka. So the value of the kwacha starts going up. Mutengo ogulira kwacha ngati amapereka kandi ndi $5 for 1,000 kwacha, now azipereka $10 for 1,000 kwacha because ayamba kulimbirana. That's how the value of your currency goes up. Ngati anthu sakubwera kuzagula zinthu zanu, mungoziwiratu kuti kwacha yanu is not in demand. Sikhala kwachayo koma chimakhala chimene akuchifunacho kumalayiko, chimene chimapangisa kuti anthu afune kwachayo. That's how it works. So as long as we don't export, palibe anthu ofuna zinthu zathu, our kwacha will always be weak. Chimodzimodzi ife tingofuna tikagule zinthu kunja, tapita anthu ambirimbiri ku banki tonse ukafuna dola kuja nkutha. Tipita ku black market yesu nakonso akuti ya ife ndiye tikwezatu. Dola iyamba kudura because tufuna zinthu zakunja kwambiri. So that's how it works. So balance of trade is basically about exports minus imports. So anthu akamanena kuti ya export led growth, timatanthauza kuti GDP yanu, economic growth yanu is driven by what? Nthawi ikoyanga tikutithalaso tichita login for the last time. Again for the last time kuti tipeze ndikankheko pang'ono kuti we stop there and then we'll continue. So as soon as we are disconnected, I will log in again, stay there. I know I have time up to 3 koloko. Mulindine, mulibe class ina, ngasi it was 1 to 3. Kaya mwatopa, tikankhane chonje pang'ono tikafike. Yeah, so I want to continue even though apopo screen changa chamba undionesa kuti